Hello, everyone, and this is our venture into the next engine, which is the valuation models module. Okay, so what we'll do over here is something like a continuation of what we learned at the analytics box. In the analytics box, we found out everything about a company as it has been reported till date, plus other info as well. But here, what we look at is exactly what the valuation of a security is. And on top of that, this has many things to offer. Most importantly, the valuation models here, we can just choose a stock. In certain cases, for some companies, some information might be missing, but overall, it is there. And from this, one can easily gauge whether a company is worth buying or not. Is it correctly valued or not? And let us choose a random stock. Let us choose NTPC and proceed. So for evaluating this has to be done with respect to an index. For India, we're going to choose the BSE, or the NSE would also work. See? Okay, so within a few seconds, there are two parts to this. First is the capital asset pricing model. On the left is a graph which summarizes the calculated alpha and the calculated beta through linear regression methodologies, and plots it. And through that, we can see that if we count on a monthly basis, then this has definitely made a progress of 0.14% growth every month. And if you plot it daily, it comes down to you remove two zeros, because you have multiplied by 100, and you can see that it has beaten the BSE by say 0.0108% on a daily basis. And it is a volatile stock because it is deviating from the BSE, as we can see the values of the beta as calculated over here. From here, we get to understand how volatile the stock is, as well as whether it is a positive alpha or a negative alpha stock. That is, whether it has performed in tandem with, or say gradually whether it has underperformed the relative index. The stock price is listed right over here, and next we move on to the firm's financial statements. This is very important, and as you can see, in three tabs, the three main sheets, the income statement, the balance sheet, and the cash flow statement, they have been totally tabulated. You can make this full screen and see the whole values. Different companies have different ways of adding up their liabilities and adding up their fees. So in certain cases, we are definitely working on that for customizing it for different classes of companies. And let us just take a quick look at the balance sheet. You can find your current liabilities, your current debt, everything right over here. And the same goes for the cash flow statement, wherein you can see how the cash has been flowing, what is the working capital, and what are the payments, and what are the issuances which is due from the company to its suppliers or its consumers. Let us move down. Next is a smooth dashboard which clearly tells everyone whether what these 5 parameters are. The first being net income, which is in crores INR. The second is the amount they hold in current assets, what their operating profits are, and what their operating cash flow is, and what their gross profit in crores is per annum. The final part is the financial metrics part. Here there's a little work left to be done, but it'll be done as soon as possible. But here we come across the main 4 or 5 types of financial ratios. The first being liquidity ratios. As you can see, you can read up the information from the wiki that we've posted over here. So the liquidity ratios here, they summarize whether a company is in control of enough liquidity to cover its short-term or long-term payouts. And for each of its case, like the current ratio and the asset-based ratio, the definitions are given over here, and the references are given right below. And here we have summarized the total current assets, and this is the current asset ratio. So if you multiply that by 100, so it's 82%. So that's pretty good. For the acid test, it's 33%. So that's also very good. Less than 1 would mean that less than 100 year, if you multiply that way. The third is the cash ratio, which has a benchmark around 1, and we can see it's pretty close to 1, which means that the firm is indeed in good health. So now there's also another side to it. That is, we can also interpret this as the amount that for every dollar or for every INR that the company borrows, it has only this much to pay back. So if it's more than 1, that's not great news. The last but not the least one is the operating cash flow. And this is defined as so. It can also be utilized as so to calculate the other unknowns like COGS and OPEX and so on and so forth, if one of these properties are not listed explicitly in the sheets. The next we come to the debt ratios, the leverage ratios. So this is about the positioning of the firm in terms of its short-term and long-term obligations to the economy. Okay, so this is the total debt that the firm has. Yeah. And following that is the debt to equity ratio. So do we have enough equity to cover that debt? Yeah. How much, this indicates that how much portion of the capital is borrowed and how much is invested in equity. So if you look at the formula over here, it can be also represented as total liabilities divided by shareholders' equity. You can calculate it both ways, and the same logic goes for many other functions or ratios which we shall come across as well as which we have already encountered. Finally, it has a comment which says that if a company has a high debt to equity ratio, it means that it is leveraging more. That means it is taking up very high amounts of cash from banks, or say it's raising money from loans or things like that. So we have to make sure that the constitution of the firm otherwise is strong. Next are the two ratios, which are the interest coverage and the debt service coverage ratios, which we are currently working on, because it's not that they don't generate values, but we want them to be accurate for the user. So this will be shortly online. Let us next move on to the most important part, the efficiency. How efficiently is your firm working? So, how much assets are we employing as a firm to generate income? So, this looks into various aspects of the company, from the time it takes to collect cash from the customers or to convert inventory into cash, and any improvement in these ratios, they generally translate to profitability. Like, for instance, the asset turnover ratio is 37%. That means NTPC only uses, say, 37% of its assets to generate the main revenue. So there's scope for growth. And this is the inventory turnover ratio, that which means that if a company makes a certain amount of goods, this is the time that it would take to clear out the inventory. It can be also calculated as follows: the COGS divided by the average value of the inventory. So now, following that, if you put it on a yearly scale, it comes down to 59 days. So like, for 59 periods, it encounters sales, and on an average, it takes 59 days, 59.32 days to convert the inventory entirely into sales. Next come the profitability ratios. So this is a metric or a measure which would give us an estimate as to how much the various costs are and how much revenue a company can generate in hand with shareholders' equity during a specific period. So this is an addendum to the previous ratios in the sense that they show how well a company utilizes its assets to produce profit and deliver value to shareholders. The first being the gross margin ratio, which is like how much a company gains for each dollar of revenue. Followed by this is the operating margin ratio, which measures the operating profits of the company relative to its revenue. So 81.4849 is quite good for this company. We can increase this, but then there are also other interconnected factors which might affect this as well. Finally, we have a return on equity. So if you multiply this by 100, it's like 28.68%. So on a yearly basis, the company's net profit with respect to its equity capital is increasing by this amount, not by 0.28, by 20.7%. So the company is growing, which is so this is a very intuitive inference, because you see, India is growing in population. These are the summer months as I'm recording this, and obviously more electricity is being consumed by the regular person. The number of air conditioning units in the country has gone up, and they require more electricity. Same goes for the introduction of EVs, so on and so forth. And as a whole, we are consuming more electricity than we did in the previous years. So NTPC, being one of the largest distributors of electricity in this country, shall see growth. There's no question about that. The next are the market value ratios. So this is a very relative measurement. It's a gauge. It helps you to gauge or compare stock prices against market prices, or against competitors' prices, and so on and so forth. First, let's look at the book value in crores INR. And NTPC is a massive firm, and this is in crores INR. Yeah. So this is the valuation of the company that has been audited into the books, and this is what has been reported directly to the exchanges and all parties concerned. Next comes the price to book ratio, which is around 2.22. If you compare this to the industrial price to book ratio, it's way low, because other power companies, they are trading at quite a bit higher PE ratios. So now, this is not a rolling PE, this is a static PE, because this had been reported on their last declarations. Next come the price to sales ratios, which means that how much is a security's price or security worth over its turnover, or price per share divided by annual sales per share. It's as simple as that. How much money do you get in, which is around 2.01. That's great. That's like twice the amount that you're getting. Yeah. Following this is the market to book ratio, and here market value definitely refers to the stock price. And as you can see, in congruence with this is also around 2.22, and that also means that yes, we are going in the right direction. The dividend yield is blank because NTPC does not directly or explicitly mention its dividend yield. It does so on a yearly basis, but the other information can be used to deduce the other ratios, like for instance EPS, which is around 21.463. The previous one was, one second, yeah. So EPS is the earnings per share, and for every unit, and this is in terms of stock, not in terms of money, which would mean that every unit of stock represents some earnings or some losses. How much is that? For that, it's 21.463 for NTPC. It can be also calculated via this route, but and if you look at the rolling EPS, it might probably be a little bit higher or lower, but this is where it's at, and this is very good, but it's lower than the industry standard, or say more or less at par with the industry standard at best, which would definitely mean that NTPC is a stock worth investing in. And look at this dividend per share. So for every share issued to the customer, you get like 0.091%, 0.091 units in terms of dividends. What I mean by that is, if a stock is priced at say around 1 rupee or 1 INR, then you get 0.091 INR whenever NTPC decides to shower you with dividends, and it generally does. NTPC has historically been doling out dividends, and they are rather handsome. Finally, we come to the last two ratios. The first is the price to earnings ratio. Yeah, this is as straight as it gets. It tells you whether it's over or undervalued, and so you can calculate like that. So it's 17.093. Now, a PE ratio isn't an EPS. Why? I would leave that for you guys to find out. But now, here is an example. Like a P ratio of 42 means that investors are willing to pay for every $1 of the company's earnings. So, $42. That means they believe that if the company does well and earns $1, well, to get that $1, investors are going to pay $42. So this is a very powerful metric, and trust me, the P ratio is much less in this case compared to its competitors. And given that NTPC is a government held entity, it is a powerful entity and it does have backing. So the growth might be slow initially, but eventually it's going to level out and outperform of that, I'm sure. The last but not the least is the dividend payout ratio, which is that like the amount of dividend that is paid to shareholders, accounting in the net income of the net income the company generates. So if a company generates a total amount in income, then based on that they shell out dividends. That's why it's blank over here, but it does have a value over here. So it's something around 0.004 per share, person per share. But that's not bad at all, because you won't be owning one share, you'll be owning many. And that's a great thing, because this is an indicator that not only does NTPC have the potential to grow, it also has the potential to give you dividends from time to time, which you can also enjoy as a part of your earnings. Thank you very much. Ladies and gentlemen, please drop in a like and please subscribe to the channel, because you see, we are as fresh as it gets, and as a startup, and we intend to use these videos to spread awareness and get into the comments. I mean, tell us how we can make it better and guide us. There will be 2 more videos wherein I go for a run through of the website, Ledgr website, as well as the Ledgr app. This is the Ledgr app, as you can understand, and there you'll see why things are interconnected and why the site is online, and the app shall be launched very soon. So these are the minor glitches which we are ironing out, but otherwise it's fine. So this is a brilliant tool to gauge whether one should make an investment. Thank you very much for your time, and thank you very much for your patience. From the Ledgr team, it's been a privilege to present to you guys. Yeah, thank you.